Industries that are hot, sectors set to outperform the market. That's what's here in Zacks Industry Rank Analysis. Charles Rotblood, our senior market analyst, puts this report together for us every week. You hear me say that all the time. He has been busier lately than a one-armed paper hanger, but he has made some time to join us once again with everything going on in these markets. You have been a busy guy lately.
I have been.
On your radar this week, oil stocks, no surprise, because we've kind of talked about them on and off for a few weeks now. As the global economy has slowed, price of oil has plunged about 70%, published reports say, since hitting a record high of about 147 and change in mid-July. Investors seem to be worried that the worldwide slowdowns have kind of tamped down the demand for petroleum-based stocks. Is that true?
It is true, and as we record this on Wednesday morning, December 17th, OPEC is meeting. They're discussing a production cut, perhaps as much as 2 billion barrels per day. Very likely by the time this video is published on the website, we'll actually know what the actual cut is.
Right.
But what's interesting is it's not just the OPEC members that are meeting. We actually have non-OPEC members such as Russia, such as Syria, that have sent representatives there. And there's a general thought that all of the, well, not all of, but the majority of the oil-producing countries are going to cut back on production. The U.S. obviously is an oil-producing country. We're not going to cut back. I don't believe Canada is either, but really the majority are, and the thought is that should help boost oil prices. But it's interesting, as we record this Wednesday morning, oil is about $43 a barrel. OPEC would like to see $75 per barrel. But one thing I should point out is that there's never been a time in history where we've seen oil drop by $100 in a period of literally less than 6 months.
I tell you, we've been seeing a lot of things lately that have never been seen in history. It's getting kind of scary. But will a cut in production really address falling demand? That's the underlying question.
It won't actually have any impact on demand itself. Really what's hurting demand is that we're seeing this global economic slump. We do have some people that have cut back. Curiously, we're starting to see that sales of SUVs are starting to rise because some people are under the illusion that cheap gas is back to stay. It's not.
One of those people.
And we've talked before off camera that if I had a way to store gasoline right now, I would do it because we're not going to see gasoline at these prices for long.
But I'm trying to burst my bubble.
But when you look at demand, it is pulling back, but it's not pulling back substantially. We're not going to see growth in demand next year, or if we do, it'll be pretty minor. But certainly, when you can make an argument that at $147, oil was definitely in a bubble. But you can make the similar argument at $43 a barrel. Oil's probably too low. Now, considering the worldwide economic situation, probably you can make an argument for oil of around $60 a barrel or so, depending on how the dollar's doing. Oil's definitely depressed, but I think if you're an investor looking at the energy sector short term, and I want to emphasize we're talking short term here right now,
right.
You're going to see further weakness because it's not just the decline in oil that's really caused a lot of these companies to cut back on production and on capital improvement projects, but it's also the credit markets. A lot of companies don't have access to the credit markets, even companies that have strong cash balances. So you're seeing a lot of companies right now that are looking at oil prices being depressed. And what typically happens in the oil cycles, we talk about boom and bust cycles. When you see oil drop, companies tend to cut back, tend to go to more cash preservation modes. As a result, any new projects, they might want to look towards the debt markets. The debt markets are closed. So we're really seeing something affect the entire sector, whether we're talking oil field equipment, we're talking exploration production companies, we're talking drilling companies. They're all cutting back. As a result, we're seeing earnings estimates cutting back. This is a trend we could continue seeing probably for several months into 2009. So it really is a case where the short-term outlook for oil is actually pretty dim. Long-term, however, valuations look really good, very attractive. Our senior oil analyst, Shiraz Mian, has been actually upgrading a lot of stocks over the past few months. He admits he might have been a little bit early with some of his upgrades, but if you're a long-term investor, it might be the type of thing where you want to consider putting these stocks on your radar screen. Maybe a little bit too early to buy them now, but if you're thinking 3-4 years down the road, you could really be looking at some substantial gains over the long term. But short term, probably further weakness, flat trading at best.
And how do you define short term? Because everybody defines it differently.
That's true. Some people short-term means 1 week, but
right.
I think when you look at oil, you really got to be thinking over really the first half of 2009. Should not see very much movement in oil stocks. Really a trading range at best. So I think that's really what people should be thinking about over the short term. They should not expect much of these over the next 6 months. When we start looking at the second half of 2009, really hard to say because we don't know what the economy is going to look like.
Right.
I think once we start seeing the economy starting to pick up back steam, that could be a period where you might want to start looking at oil prices. One thing investors should understand is that the brokerage analysts have been behind the curve on oil prices. They were raising earnings estimates after the oil bubble burst, and they really were too late to start cutting estimates as well. So likely we'll start seeing conditions improve in terms of the oil market long before we start seeing the estimates revised upwards. But because of the credit markets, there still could be a lag. We could see oil prices rebound, but actually not the oil companies spending money yet, partially because they want to make sure the oil rebound sticks, and partially because of what the situation in the debt markets is.
All right, so today we're talking about production cuts in the news. But long term, we're talking about higher prices in oil. So help me understand this. Higher prices long term will eventually mean less demand, and less demand means excess supply in the long run. So,
well, the thing is, you will, at some point, higher oil prices are going to curb demand. We haven't seen it yet. For all the talk about conservation, Americans do a really horrible job of it. The Chinese, India, they're all seeing increased use of cars, increased ownership of cars. All that's going to drive up demand. Plus, we're looking at really peak oil, meaning that most of the oil has already been taken out of the ground. Doesn't mean that we're going to wake up in 2011, have a long line at a gas station because there's no oil, but we're at the point where it's going to cost more to get oil out of the ground. There's now more competition for the oil that's left in the ground. So we're really looking at a period of really supply and demand where the demand is going to gradually outstrip the amount of supply, and that's going to cause a long-term run-up in oil prices and hopefully spur real investment in alternative energies. If I were investors looking at the long-term as far as what people are going to use, I would say natural gas is going to play a far bigger role over the next several decades than oil. Certainly, I think T. Boone Pickens has it right when we're talking about gas. When you look at fuel cells, you look at possible funding, some other types of sources, natural gas will be the long-term choice of commodities over oil, but we will see oil prices go substantially higher and really to new records. 147 will seem cheap at some point. I don't want to put a year on it, but we will see oil go substantially past that.
It's not good news.
It's not enough. It's really more of a matter of when.
All right, Charles does a real good job in the text piece of this report telling the investor what all of this means to them. And so I think you should really take a hard look at the text version of this industry rank analysis for this most current week. By going to Zacks.com, looking for the headline down the page, and then clicking on it, it'll take you right to it, as well as an archive of some of his other recent industry rank analysis that he's published. With Charles Rotblatt, I'm Terry Ruffalo.